details. The floor for questions, clarification before we go ahead into the business of today. So I'll be using the next 5 minutes to answer questions that you may have on things that you are not so clear on, and then we'll take it from there. If you don't ask me questions, I'm going to ask you questions. So you might want to use this opportunity to ask whatever questions you have. Okay, now let me ask my questions. Good. So who can tell me one? Good. A company A acquires another company B. Company A has a PE ratio of 10. Company B has a PE ratio of 15. Is the deal accretive or dilutive? And why? Anybody can answer the question. Nobody wants to answer? No, go ahead.
Up. So put
go ahead.
Okay, the deal is dilutive.
Why?
Okay, I can remember clearly. Yesterday class, you said if the P ratio of the buyer is greater than the P ratio of the seller, then the deal is accretive. But he said that's only if it's an all stock deal. Thank you.
Oh, okay, thank you. So the answer to that question is you are partially correct. The answer to that question is you don't know. You need to ask for additional information. So when you hear a question like that, you want to ask for additional information because the consideration, which is cash, debt, or stock, has to be known before you can be able to tell if the deal is accretive or dilutive. So in that kind of question, you ask, oh, what is the consideration? If they tell you all stock deal, then you can use that particular principle of if the PE ratio of the buyer is greater than the PE ratio of the seller, then the deal is likely accretive. Then, but if the reverse is the case, it is dilutive. So yeah, well done. Now another question, just to like test our understanding. I think I should share my screen. I have a couple of questions that I want to use to like, gauge the understanding that you might have had on this. Okay, good. So next one is this. Company A acquires company B. Company A has net income of 100 and market cap is 1,000. Company B has PE ratio of 20. The cost of debt is 5%. The tax rate is 40%. Debt equity is 50-50. Is the deal accretive or dilutive? So how do we solve this question? Who can like, take a stab and tell me? Who can take a stab and tell me quickly before we go through it? Because we have to go through it today before we like, hit the ground running. You can take a stab. Okay. Anyone? Okay, let me just give you give you some ideas before we go ahead and solve the question. Remember yesterday I told you that the rule of thumb whenever you want to solve any accretive or any someone wants to answer? Sorry, I cannot see my screen, so I cannot see anything. Okay, good. Let's go ahead with this. Good. So I told you yesterday that the way you evaluate this is you compare the cost of is somebody raising their hand? I can't see. Okay, Benjamin Oludayo. All right, go ahead.
Yes. Sorry, can I see your screen again? He said company A has a net income of 100 and their market cap is 1,000. Yeah. Then company B has a PE of so cost of debt is 5% and the tax rate is 40%. Debt and equity is 50%, 50-50. So we are to get our cost of debt and we are to calculate our worker for A and the seller's yield for company B. Company B seller's yield will be 1 over PE, which is the reverse of our PE, 1 over PE, which is 5%. And for company A, we have to get our worker using cost of debt 5% multiplied by the tax 1 minus tax rate multiplied by 50%. Then equity cost of equity multiplied by 50%. Cost of equity will be our cost of equity will be our net income for seller for A divided by their market cap. So that would be 10% multiplied by 50% for company A. Then whichever is greater, we determine whether it is accretive or dilutive.
Excellent. That's exactly the case. Good. So just to make this very clear, let us come up with our let us solve it. So the question says that company A and company B. Company A's detail is that net income is 100. Then MCAP is 1,000. Company B is we have the PE is 20, and the cost of debt is 5%. Tax rate is 40%. So we are saying debt equity is 50-50, so have 50%. Good. So now, remember yesterday, I told you that whenever you want to compare if a deal is accretive or dilutive, the decision rule is very simple. You compare the weighted average cost of acquisition to the yield of the seller. Because in this case, what we are buying essentially in a merger or acquisition is that we are buying the yield of the seller. That's what we are buying. Yield essentially means returns. We are buying the returns that the seller can give us. That's what we are buying. So let's start from the yield of the seller. How do we get the yield of the seller? The yield of the seller essentially is what we are getting divided by the price you are paying. In this particular case, we are assuming that we are not paying any premium. That's the assumption here. We are not paying any premium. We are just buying exactly the yield that the seller currently gives us. And now there is this important statistic that is called PE. That's price over earnings. That's essentially what it means. Price over earnings, price being like the market capitalization or the equity value of that company divided by the earnings of the company. Yield is the reverse. Yield essentially is 1 over the PE ratio. And what that means essentially, remember what I said, yield is the earnings you get divided by the price you pay. So the earnings you get is this earnings here, E. Why the price you pay is what? The equity value. But they've already given us this PE as 20. So if we want to get the yield of the seller, it will be 1 divided by PE. PE, that's essentially what it's going to be. And then for this case, it's going to be 1 divided by 25%. That's what it is. That's what the yield of the seller is. So we already have this. Sorry, I'm very poor with spellings. We already have the yield of this. We already have the yield of the seller here. So what we are comparing this thing with now, the next thing we want to get is let me take this down here for simplicity purpose. So we are comparing to the weighted average cost of acquisition. Cost of acquisition in this case is determined by the consideration. So what is the consideration here? They are telling us is debt and equity. So there is no cash. That essentially means that we are comparing the weight of debt multiplied by the cost of debt multiplied by the tax shield plus the weight of equity multiplied by the cost of equity. So very, very simple. We have the cost of debt is very simple. They've given it to us here 5%. So we are good. We already, what is the weight? The weight is what? 50%. So I think for the, and we have tax rate already. So we already have the debt component. The next component now, equity. For the equity component, we know that equity component is also 50%. Weight is 50%. Now the cost of equity. For the cost of equity now, it's slightly like it's very tricky for us. If they've given us the PE of company A, you would have done 1 over PE of company A is also the same thing as the cost of equity for this particular company. But here, what did they give to us? They gave us net income and they gave us market capitalization. Remember, for company A, I already told you that the yield of company B is essentially earnings divided by price. In this particular case, the cost of equity is also the same as the yield of company A, and it's also the same formula, which is what? Earnings divided by market cap or equity value. We've been given the earnings. Earnings is what? Net income. Earnings and net income is the same thing. Then the market cap is the same thing as equity value. So that's 10%. So the cost of equity here is 10%. Now, to get our WACA is very, very simple. We've already said it before. The weight multiplied by the cost here. There is no tax implication for equity, so we leave that. Then multiply by the weight of debt, multiply by the cost of debt, 5%. But now there is a tax implication, so we have to add that tax implication, multiply by 1 minus 40% tax rate. Good. So what do we have here? 7%. So 6.5%. So it means that this with the cost of capital is 6.5%, but the yield, what we are getting, the result is 5%. So is this deal worth it? No, it is not, because of what? We are using, like, essentially, we are typically using 6%, 6.5% to buy an asset that is generating 5% per year. So this deal is what? Dilutive. So that is it. I hope this is pretty straightforward. So the last one we are going to do today, before we go to the next subject, is the last question. Company A acquires company B. I want us to take a stab at this question for the next 5 minutes, and then somebody explain it to me when you're done. Then we'll take the next 5 minutes to solve it, and then we'll go to the business of the day quickly. Let me make it clearer so that it was it. Okay. So anyone wants to take a stab? Have anyone gotten the answer?
Oh, please give us 5 more minutes.
Okay. You said I should give you 5 more minutes. I can't give you 5 more minutes. Let's see, you have 2 more minutes.
Okay, okay.
Okay. Who wants to take a stab? Benjamin.
Okay. Using trial and error method, 58% is the most amount of debt you can use to get a 4.9%, 4.9% that will make it accretive. 58% of debt and 40% of equity is the most you can use, but then we can use less than that.
Okay. So you are saying 58% of debt, Abby? 58% debt, 42% equity. Does anyone have a different answer? Anyone has a different answer? Okay, let's solve it. It says that company A, company B. So let's take the details together. As usual, we'll have company A, we'll have company B. It's usually very easy to start your analysis with the seller. That's usually my preferred approach. So company B's PE, they give you company B's PE to be what? PE is 20. That's company B's PE. Company A, okay, you're also giving company A's PE, so excellent. You're giving company A's PE to be what? 10. Then next thing you were also given is that cost of debt is 5%. Cost of debt is 5%. Tax rate is 40%. Good. Tax rate is 40%. So the question says what is the weighting of debt and equity that will make the deal neither accretive or dilutive? Remember, just the same method we used now. We get the yield. The yield of the seller, get the yield of the seller. The yield of the seller, as we said, is what? 1 over the PE, which is 5%. So what the question is telling you is that what is the mix of debt and equity you are going to get given this information that you have that will make this deal neither accretive or dilutive? That's essentially what the question is telling you. So you can use a simple mathematical formula to solve it. Just get your weighted average cost of acquisition. So for weighted average cost of acquisition, as we said, we use the weight multiplied by the cost of debt multiplied by the tax shield plus cost of equity multiplied by the weight of equity. But we don't know what that weight is. So we just use like a mathematical formula. We can just say let's weight be equal to, say, let's say the weight should be equal to X. Then essentially, because of the weighting should be 100%. If this particular weight, if you say 1/8, one of the weight is X, the other one will just be like 100 minus X, essentially 100 minus X. So let's say this is equity, then this is debt. So if you use this particular structure, what your structure is going to look like for your weighted average cost of acquisition is going to be, as we said, we've not gotten the cost of equity here. Cost of equity here, since they gave us like the PE ratio, is also the same thing. It's going to be 1 over the PE, which is like 10%. So that's cost of equity here. So here we have cost of equity, which is 10%, multiplied by the weight X, plus cost of debt, which is what, 5%, multiplied by the weight of debt. We said 100 minus X, right? Then multiply by 1 minus the tax rate, 40%. So this particular thing has to be equal to 5% for this deal to be considered non-accretive, to be considered neutral. This equation now has to be true. So essentially what this means is that our weighted average cost of acquisition has to be equal to the yield of the seller for this particular equation to be true. So we want to get X. That's what we want to get. So we want to get X. For us to get X here, we can be able to, someone has a question? Okay. We have, for us to get X here, we have to, like, just do the numbers. So this is 10% of X. 10% of X plus 5% times 1 minus 40% is actually 60%. So we have 5% times 60%. That's 1 over 20 times, what's 5% of 60%? Somebody do that quickly. 10% of 60%. 10% of 60 is 6, right? 5% is supposed to be what, 3, right? 3.
Yes.
Yeah. 3% times, so 3% into 100 minus X. So 100 minus X has to be equal to 5%. So from here, the next thing we do, we open this bracket. This is 10% X plus, opening this bracket is 300, right? Then minus 3% X equal to 5%, sorry. So from here we have 7, this is 7, collecting the like terms will just give you 7% X. Then you take this other one to the other side, then this is going to be equal to 3, well, this 300%, okay. This 300% minus, this is 5% minus 300%. Something is wrong here. I should have just done 3% of 100. Oh, sorry, 3% of 100 is 3, sorry. 3% of 100 is 3, right? Oh, apologies. So there are 2 ways we can do this. One of the things I was trying to do here was to use percentages to solve this. We can use percentage to solve this. We can either use percentage to solve this, or we can just use like pure decimals to solve it. From what I'm looking at here, I think if we just go the percentage route, it might make things slightly difficult for us, even though we still get the same answer. So what I'm going to do in this dead side is to just use the decimals the way they are. So I'm going to get my answer in 0.0 something format. In that case, if the weight of equity is X, then debt is going to be like 1 minus X. It's still the same thing as saying 100% minus X%. Still the same thing. But I don't want us to go through that route because it's going to make this particular calculation complicated here. So if that is the case, that means in every of these places I put 100, I'll just make it 1 minus X. 1 minus X in each of these places. So from this particular point, this is going to be 3%. From this particular point, this will be 3% times 1 is going to be 3%. And 3% minus X, 3% times minus X is going to be minus 3% X. So we equate all these things to 5. I just hope I've not made everything complicated. Here we collect the like terms from this point. This will now be 10% X minus 3% X, which is going to be what, 7% X. And the other point is that 5%, 7% X equal to 5% X, 5% minus 3%. So what I did was that I just took the 3% to the other side. And then at this point, we have our 7% X is equal to what? 2%. You just do your normal mass. Just divide both sides by 7% here. So your X will now be equal to 2 over 7. So that's like 28.5%. Let's just say approximately 29%. So your equity weight is going to be what? 29%, while your debt weight is going to be 1 minus this 71%. So this is the weight that is going to make this deal neither accretive nor dilutive. So I think Benjamin, you tried, but I think one of the things you left was the tax implication, because the tax implication is going to reduce that particular Benjamin.
Yes,
I have a question.
Yes, I got my corrected answer in the chat box.
Okay. Excellent. Yeah. So just slightly, okay. Ibukun got 62.4, 37.6 weighting. Okay. Yeah. So Ibukun, how did
my error? There was a calculation error on my book.
Okay.
I've corrected myself. Thank you.
Oh, okay, good. So it should be around like 28.5 to 70 point something. So that's to 72 point something. That should essentially be the answer. So great work, guys. Thank you very much. So we'll go to the next thing that we'll have for today. One of the advice I want to leave you with is if you are going to do like, an investment banking interview, or any interview within the finance space that requires M&A, my advice to you is to solve a lot of questions like this, because what they are going to test, nobody's going to start testing you on how you can build a model, except maybe in the final stages. You want to understand how these numbers essentially work, because at a very concrete level, so that whenever you are working on the model, it becomes very intuitive. That is why I'm giving you some of these, measurements, so that you'll be able to understand how they flow across around. So I just hope that for you to be able to like master this, you want to like do a lot of problems, solve a lot of problems. I think after the class, I might try my best to like, put questions together and share with every member so that you can walk through them and see how good you are at it. It just helps you refresh your mind so that you know how these numbers work. So without further ado, we'll go to the business of the day, leverage buyouts. When you hear LBO also means leverage buyout. Remember in the class yesterday, I was telling you about the different, was it yesterday or day before yesterday, about the different kinds of people that buy stuff, that buy companies. I told you that they are divided into two broad categories. That one is the strategics, the other ones are the financial sponsors. Strategics are usually corporations or companies, and they buy it for like reasons like synergies or whatever, and they tend to pay higher. While financial sponsors are like private equity companies. When you hear financial sponsors, they are mostly private equity companies, venture capitals, but mostly private equity companies. They're the ones that buy companies for financial reasons. So the big difference between a strategic and a sponsor is that a sponsor, because they are buying it for financial reasons, they don't hold that company for a long period of time. They exit that company within 5 to 7 years. That's typically what they do. And that is what gives rise to what we call a leveraged buyout. From the name, leveraged buyout, one of the things you have to see, one of the things you want to pay attention to is that word leverage. In finance, leverage is debt. Whenever you hear the word leverage, is debt. So how come do private equity or sponsors buy companies with leverage? That's essentially what the concept of an LBO is. So our agenda is that we'll talk about what an LBO is. We'll talk about why we use leverage. We also talk about the structure of an LBO. We talk about how you identify good LBO candidates. Talk about the key value creation drivers in an LBO. We do practice about paper LBO question because we will not be able to do like a full LBO. Because it's something that will take beyond this class. And honestly, I don't think it's going to be very useful for us at this point in time. Then the last one, we'll do ranking of real companies. And then I'll give you an assignment too on this particular subject. I gave you an assignment already on M&A. We'll increase the scope with this particular one so that whenever you are submitting, you're submitting like a full report. So just to put a caveat, what is an LBO? Let's start from an LBO. You can liken an LBO to like, a home. When you buy a home, maybe this is not so popular in Africa because of our credit system, but usually when people buy homes in developed countries, they buy it with a mortgage. That's typically what they do. A mortgage is like a debt that is given to you. You supplement it with your own cash and use it to buy a house. And then typically you take maybe when you finish buying the house, maybe you use like 70% debt, then you put down payment of 30%. You're now getting rental income from that particular house. When you're getting it for a while, you are using that rental income to pay the interest on the loan that you took to buy that house. And then maybe at a point in time, maybe you improved the house, you put some things, you renovated, or maybe the house just increased in value over time, because there's this thought that housing or real estate increases over time in value. Then let's say you bought it for 100 naira. For 100 million, let's use a practical example. As a practical example, so LBO. So LBO. So you buy a house for, say, purchase price. You buy the house for 100 million, and then for this 100 million equity, your equity contribution is just 30%. That's essentially what your equity contribution is. That means debt is essentially going to be 1 minus 30. Oh. Sorry, purchase value, the equity value is 70. So in terms of percentage, you have like, this is 30%, while this is 70%. So that is how you bought the house. And let's say your interest payment, which is the cost of debt. Remember, cost of debt, interest payments, they are the same thing. So your cost of debt or interest is, let's say 10%. Let's say 10%. So 10% of, remember, not 10% of the purchase price, but 10% of the debt. So you are paying interest every year, $7 or 7 naira every year, or 7 million every year. But maybe what you are getting in rent, maybe you built like the house in Lekki and you are getting rent of 10 million every year. Essentially, what it means is that every year, from the rental income you are getting, you can be paying your interest of 7, and then you still be getting some cash flow for yourself of 3. But remember, that cash flow, you can either decide to use that cash flow to be paying down the interest little by little, or you can use it for other particular purposes. That is essentially how an LBO works. But yeah, instead of buying real estate, you use it to buy companies. Another important thing that makes this particular analogy slightly different from what we typically know for housing is that it is held for a short period of time. So it is held with an intent to sell. So financial sponsors buy a company with an intent to sell. That's why they buy it for financial reasons. But strategics buy a company because of they want to be able to use it for other reasons that we talked about. That is what an LBO is. So an LBO, the elements of an LBO are: one, there has to be leverage. It's important. If there's no leverage, it's not an LBO. That's why you see in developing countries like Nigeria and other parts of the world, LBO is not really a big thing. So this model I'm teaching you for knowledge's sake, because for a lot of companies in Nigeria, they typically do not do LBOs because the environment does not allow you get a lot of credit facilities. Secondly, the credit terms in the country or in the developing world is is because of they are considered risky. The cost of debt is very high. The interest is very high, so it doesn't make sense. Because if you are encumbered with that kind of huge interest rates, it will be very difficult for you to meet up your obligations and get a return. That's why it's not usually useful. But for developed countries that have well-developed credit markets, both in the private sector, both in the private market, institutional markets, and every other kind of market, they can be able to do it very, very well, and then they essentially reduce their return. So the question is this: why use debt in LBOs? There are different there are three reasons, but the most important reason is that debt amplifies returns. So if you buy, let's go to this our example. For this particular housing example, is 100. If you had bought this house with 100, let's assume that selling price. Let's just do this analogy very quickly. So say you sell it for 200, and you bought it for 100, and you use 100% equity. Let's say your equity is 100%. Just use 100 to buy this. Your profit is going to be essentially, or your return on investment. Remember, your investment is 100, and then you sold it for 100. So your return on investment is going to be 200 minus, let me just use this, 200 minus the purchase value divided by your initial investment, 100. So that means in percentage, you got 100% return on investment. That's what you did. But now, imagine that you used debt. You use debt, and let us assume that our cash flows were such that we just paid our interest. We were able to clear our interest. And then we still sold this for 200. So what our net return essentially is going to be, let's calculate our return. So we are getting 200, but now we paid interest. We paid our debt back 70. So what is left for us is what? 130. Now our ROI is going to be what? 130 divided by essentially our investment. Our investment in this case was 30. So this is 333%. Why were we able to get a higher return on investment, even though we sold it for the same price? We're able to do that because of what? Leverage. So one thing about leverage is that it amplifies returns. Remember, amplifies returns, not, it doesn't increase returns. It doesn't boost returns. It amplifies returns. The implication of that term difference is that because of it amplifies returns, if your investment was bad, if you had negative investment, with leverage will make it worse. So the reason why people use leverage in business generally is because it amplifies their returns in different ways. One, it gives you tax shield, which we've talked about. Secondly, it amplifies your returns in terms of the projected returns you are going to get. Thirdly, it makes you financially disciplined because you are paying a compulsory interest payment. Fourth, it gives you some liquidity, it gives you some liquidity cushion. There are a lot of other reasons why people use debt or whatever they use it for. But for an LBO, these are the three top reasons why we use it. One is that it reduces our upfront cost. the way private equity company works is that they raise capital from people that we call LPs, that's limited partners. So you can raise a fund of $1 billion and you want to use that fund to buy companies. If you use the entire 1 billion to buy companies, you will just be limited in the number of companies you can buy. But when you're able to get debt, it amplifies, it gives you a boost so that you can be able to buy more companies. So with a 1 billion investment, you can even 10x your potential. So you can even buy companies up to like 10 billion, and the rest of the 9 billion is going to come from what? Debt. So because it reduces the upfront cost you spend on buying one particular company and gives you more equity or more capacity. The second thing is that the second reason is that you will use the company's existing cash flow to pay those debts. You repay the debts and also repay the interest payments. So it essentially gives the company financial discipline. And the third and most important is that it amplifies returns. So again, just to point out, if there is no debt, it is not an LBO. Once there is no debt in the mix, it is not an LBO. Now we'll go to this thing. How is an LBO structured? Essentially, I told you that it's financial sponsors that do this, essentially PE. But the way it is done is this. So the PE does not just raise the debt in their name. No, they create what we call a holding company. After they create that, if you were in my class for project finance, this is very similar. It's very, very similar to a project finance. Very, very similar because project finance companies also create what we call SPV, a special purpose vehicle, which is essentially to buy a specific asset. For a PE company, they create a holding company, which the purpose is to buy a lot of assets or portfolio of companies. But then there's one interesting twist. They don't raise that debt in their own name. They raise the debt in the target company's name. That's one of the very sweet things about private equity, which made a lot of people start talking about them not creating value or just being financial engineers, because what that does for them is that they are not held accountable if things go bad. They raise the debt in the target company's name. And then for some reason, the target companies essentially, like, they agree to this. They agree to this, and it's quite surprising and shocking that they can agree to something like this.
Hi, Testimony, you're muted.
Sorry guys. So as I said, the next thing is that one of the things that made PE companies get a lot of the bad reps they get is because of the fact that if things go wrong, they are not held accountable. For some of you that might have heard about RJR Nabisco and KKR deal, I think it was in the late 1980s, which was like the point where private equity was like a king and doing a lot of massive deals. It was one of the things that gave them a bad rep, because that particular deal ended up being like a disaster, even though the private equity company at the point in time got returns from that particular deal. If you've not read it before, go and read about RJR Nabisco. I think there's a book and a movie about it, Barbarians at the Gate. Potentially, I will also share, maybe I have a case about it that I could share. I'm not sure if I still have it, but I'll find it and then share about it. You can read through it and just see the history of private equity. But again, for the case of this class, what we are doing here is that you have a financial sponsor who creates a holding company. They use that holding company to raise debt in the target's name, and then they add a little equity to buy the target. So they can raise debt of 80% and then use 20% add to it to buy that target. And then they use that target cash flows to repay the debt. So you see, when a lot of people talk about private equity, what makes private equity a very, very interesting asset class, or makes it very interesting, is the fact that you're able to analyze a lot of companies, and then you're able to see the ones that are good candidates that you can buy, use the cash flows to repay debts, and then you can be able to make a return at the end of the day. So an LBO analysis essentially is just like an M&A analysis. But what makes it slightly different, or the differences, is that one, you are limited, your consideration is limited. I think that's the next thing we're talking about. I didn't have it here. What makes an LBO analysis different from an M&A analysis is that, one, your consideration is different. For an M&A, you are buying the company, you have 3 options to buy the company: debt, cash, stock. But for an LBO, it is all cash. But the cash now, some of them comes from equity, some of them comes from debt. That's essentially where it comes from. That's essentially where the sources of cash come from. Some of them come from the private equities equity, and the other one comes from, like, debt. Another important factor is that it is held for a short period of time, and it is held for sale. It's not held, like, to maturity or any long period of time. It is strictly held for sale. That's essentially what makes them hold those companies. Now, because of that intention, there are some companies that are not good candidates for an LBO. There are some companies that are just not set for an LBO. They are not good for an LBO. For example, say you want to LBO, let me use a new startup company. Say which startup company can I talk about now? I don't know a lot of startups as much. Let me see. This stack is already mature, so I'm not going to use them. Chowdeck, for example. A Chowdeck, for example, is not a good candidate for an LBO because it's a startup. Even though it has potential, there are some features that it does not have that makes it, apart from the fact that it's very small for big private equity companies, apart from the size, the another thing again is that it does not have stable, predictable cash flows. So companies that are usually targets for an LBO is that, number one, is that the stability is the most important thing. They must have stable cash flows, that have cash flows that are predictable. It's not cash flows that are just like, it's 20% today. So a company that has cash flows that is 20% today and tomorrow 1,000,000%, even though that difference is much, is not as attractive as another company that has predictable cash flows where it is just like, growing steadily. That's one. Secondly, is that it must have like low fixed costs and high recurring revenue. So the revenue again recurring, which flows into like the cash flow predictability. And that thing again is low fixed cost, so that you know that you are coming in and you're not investing so much in an asset that has to now generate profits in the future period. So now I want to ask you a question. I want to ask a question now. I want someone to give me an answer. Why do you think that low fixed cost is important for these LBO candidates? Why? You can tell me a financial reason why. You can tell me a financial reason. Okay. One financial reason, again, we can talk about is that because of this, it goes back to the intention. These companies are held for sale. So if you're buying assets, or if you are getting any assets generates money for you over a long period of time. So if I'm holding an asset if I'm holding a company is also called an asset, by the way. If I'm holding a company for 5 years period, and I'm buying an asset that is going to generate money for me or recoup its investment in the next 10 years, it's not a good investment for me. So I'm looking for investments where I don't have to invest so much in fixed costs that will be generating money for a period that is longer than what I want to hold that money for. That's essentially it. So I'm not buying that. Another one again is strong EBITDA margins. EBITDA, name for EBITDA is earnings before interest, tax, debt, earnings before interest, tax, depreciation, and amortization. Remember when I said earnings and net income is the same thing. So if you want to get EBITDA essentially is you take your net income, you add your interest, you add your tax, you add your depreciation and amortization. That is EBITDA. It's a very important metric because of it's a very good proxy for free cash flows. It's not the same with free cash flows, but it's a very good proxy for free cash flows. That's why we use it. That's why we use it in finance, because of it's very, very it's a very important metric. Another one again is that we are looking for investments that are very low, that have low valuations. And one of the ways you measure valuation is what we call EV/EBITDA multiple. I already told you about I think we talked about valuation before, but maybe later at a point in time we'll be able to do and we're able to do another class on valuation, talk about valuation in detail. But then yesterday when we're talking about M&A, I told you one important thing. I said that whenever you want to buy a company, one of the important things is pricing. Pricing is very important. So this EV/EBITDA multiples is just to tell you the price you can potentially pay. If it is low or mid, then it means you are paying less. You can potentially pay less. But if it's very high, definitely you might want to pay. You might want to pay so much. And pricing is, in fact, the most important thing you can talk about when it comes to buying or selling, buying companies. Pricing. Then they has tangible fixed assets because of a collateral purpose anyway. So because of that, it's better for me to buy what's the name of this Tony Lumelu's company? This company that does Transcorp. It's better to buy a Transcorp that has a lot of fixed assets than buy like a Money Point. It's better for me to buy that because of it has a lot of fixed assets which I can use as collateral, or if things go back I can sell them and recoup my investment. So these are like quantitative factors. So we have other qualitative factors that are fuzzy. They have strong management, the barrier to entry is low, moats, like maybe the industry is such that it has very low barrier to entry. Then they have a clean capital structure. You know what capital structure is now? Debt and equity mix as capital structure. So the reason why we want ones that have clean capital structure is so that when we can load debts, we know that we can load a lot of debts on that company. So if it has a very, very low debt profile, we can load a lot of debts there. Another important thing is that exit opportunities is very important. Remember, we are selling this company within 5 years. If people are not buying this company, we don't have any people we sell it to, then it doesn't make sense, even if they have all those factors. It's just that we are holding an asset that we know that we cannot sell. No. That's why you see a lot of people, even though tech companies are not typically good LBO candidates, you see a lot of tech PE firms like Vista Capital. I think there's also Thoma Bravo, and I think there's also Silver Lake. They are becoming very, very popular. So they are just focused on buying tech companies. And the reason why, even though tech companies are not typical LBO candidates, why do you have a lot of PE companies buying some of these companies today is because of exit opportunity. That's it. Then avoid relying solely on multiple expansion. We'll talk about this one in the next slide. Good. So this question is something that is very important if you're going to a PE firm. Maybe you're going to a PE shop for an interview. You might be asked this question: what are the key value drivers in an LBO? What this question essentially means is that what are the things that give returns in an LBO? And they are mostly three: EBITDA growth, multiple expansion, and debt pay down. This thing is like the holy grail of LBO interviews. Like, it's something that you have to know. I'll tell you what it means. So you can be able to improve value in an LBO. It doesn't go beyond these three. That's how value is improved. That's how you get value. It's either the company grows operationally and it is reflected in the EBITDA or the profits in this case. Okay, you bought a company, you can drive value in that company in three ways. First one is that you increase the profit of the company, which reflects in the EBITDA growth. And typically you increase the profit of the company when you improve operations. Maybe you open another branch internationally. Maybe your staff become more efficient. Maybe you cut costs. So all these things are the things you pull, levers you pull to increase the profits or EBITDA. That's one way that at exits, you can be able to make more value, because in the beginning, you had a lower profit, but in the ending, you had a higher profit. So even though you are selling it for the same multiple, you are going to make money. That's the first part. The second one is debt pay down. For debt pay down, you are using the cash flow of that particular company to pay down the cash, to pay down the debts that you took. So what that does for you is that because you've used the cash flows of the company to pay down the debt, you don't have to use your own money to pay the debt, even though in the PE, they don't pay the debt with their money. I remember I told you that it is the target that the money is raised on. So what that does for them is that whatever income they are getting at the end of the day, it's going to improve the margins they are getting on their own equity investment. The third one is multiple expansion. What multiple expansion means is that if in the beginning I buy the company for 10x meaning that maybe my EBITDA is 100 and then 10x EBITDA is like 1,000. So I bought the company for 1,000 because of my EBITDA is small, because of my EBITDA is 100. When I'm selling it, I can potentially, maybe if the market becomes better, I can sell it for higher than 10x. I can sell it for 12x. So even though if I have EBITDA of 100, because if I'm selling it for 20x at exit, I'm getting 2,000. So that's another way I can make value. That's the meaning of value drivers in an LBO. Essentially, it's the way you can be able to make gains or the way you can be able to profit. There are three again. And as I said, there are the three most important ones. In fact, they are the three only ones. One is EBITDA growth. Second is debt pay down. Third one is multiple expansion. Then this entry price, buy well, is something that, holy grail, as I said. You must buy well if you want to sell well or if you want to improve. If you don't buy something at a good price, it no matter how good that asset is, you will not be able to make anything. So yeah. Now let's do a quick sum. Let's do a quick let's test our knowledge. So look through these companies, and then I'll give you 5 minutes to look through. Then when you come back, you tell me which one is the best. Rank them first, second, third, fourth in terms of which ones are the best LBO candidates. Just based on these metrics you're saying.
Can you share the slide? I can see. Yeah.
Okay. I think I see some answers. Somebody said Boa first, Ibito second, Dangote third, Lafarge fourth. Any other answers? So Olaoluwa, why did you choose this order? Tell me. Olaoluwa, why did you choose this order? Olaoluwa, are you here? Deborah. Okay, go ahead, Deborah.
Okay.
Please, can you show us the question again? Thank you.
So why did you choose Boa?
Okay, can you hear me?
Yeah, I can hear you.
All right. So I was saying, Boa is the first because it has the strongest EBITDA of the four of them. It also has, it also has strong margins. I think it has the strongest margin. The FCF trend is strong compared to the remaining three, and then the EV EBITDA is it's reasonable. So if you compare the four metrics that we have, it has three that are the strongest. So Boa is first.
So why do you think the EV EBITDA is not a good thing?
I didn't say it wasn't a good thing. I said it's reasonable.
What does EV EBITDA? Yeah, what does EV EBITDA mean to you?
Okay, it's the enterprise value of the company over the EBITDA of the company.
Good. So what does that tell you?
So it means that the
there's a word I'm expecting.
Can
I'm
cover
to say something.
the EBITDA 5 times.
Okay. So what does that mean?
Yeah.
You're getting there. You're actually getting there. I want you to get there. Like you're getting there. Okay. Let me help. Does anyone have an answer to it? Okay, Benjamin. There's something I want you to say.
Okay, so I believe their EV to EBITDA value, that's their enterprise value to their EBITDA. That means they're making 1/5 of the value of the company. They're making like 20% of the value of the company per year.
There's something I'm expecting to say. Ibukun Olua.
Yeah, I think the EV EBITDA ratio tells you how many times the company's operating cash flow would be needed to like paid for its total value or something.
Okay, good. I think you guys are saying all the right things, but what I wanted to hear is that EV EBITDA essentially is a measure of value. That's essentially what it is. And measure of value is EBITDA is usually the metric that is used to say, okay, if this company has an EBITDA of 100, the value of the company is 5 times the EBITDA. So if I want to buy that company today, if I know that the EBITDA multiple, the EV EBITDA multiple is 5x, I'm going to pay for that company is 500. So it means the company is cheap. That's essentially what this means. This measure of value means this company is cheap. So the lower the EV EBITDA multiple, the cheaper the company. The higher the EV EBITDA multiple, the more expensive the company. So it is not a bad thing. It's in fact a good thing. That's essentially what I was trying to bring out. So this company is cheap. So these ones that have low EV EBITDA multiples are cheap companies. And remember, one of the things I told you is that price is the most important thing. That's why in that LBO, good LBO candidate, I told you low to mid multiples. Because and that multiples essentially is telling you the price that you pay, or that's essentially what it is. So EV EBITDA, enterprise value over EBITDA, that's essentially what it is. So if this one is 5x, if the EBITDA is 100, the EV is 500, which gives you like 5x. So these companies are cheap. So the cheapest companies here is Boa and Lafarge. They're the cheapest companies, and that's where I will start from. The cheapest is what? Boa and Lafarge. But then I now go back. EBITDA of this one is what? 1.4 plus 1.4 billion. Big. The margins from this EBITDA, from the margins essentially is even high. Then they say the free cash flow trend is strong. That means it's growing at a predictable rate. So automatically it means that BUA is the best option for me, because this is not only is it cheap, it has a very high EBITDA, and also the margins are strong. And the FCF, like the free cash flow conversion from the EBITDA, is actually very strong. These are things that we'll do when we are doing financial analysis. I just hope we'll be able to have time to like drill deep into some of these things, because I feel like it's things that is going to make you guys very, very better financial analysts. So the verdict here is that BUA is clearly the leader here, number one. Lafarge, not so much, because the margins are small and the free cash flow trend is even falling. So even though Lafarge is a similarly good target, the fact that the free cash flow, that is the cash I can even get from this business, is falling, makes it like, you know, not a good candidate. I go for the next thing. Remember, one of the things I told you about is that you want a company that has what steady cash flows or stability in terms of predictable cash flows. So from what we are seeing here, the cash flows of this one is even falling, so we'll leave it alone. It's on its own. We'll go to the next one, the one that has like, you know, the next cheap one, EBITDA 9.5x. They said that the free cash flow is good. The margins are just 13%. So I think the biggest, the ones that are closest in terms of analysis is like Dangote and Ibeto, because they have they have similar value, but Dangote has steady cash flows, while Ibeto's own is just okay. Then when you go to the margins, clearly Dangote beats Ibeto. So for me, I think the next one after BUA is Dangote. Then afterwards is going to be Ibeto. Lafarge is just very poor because of its bad cash flows. The kind of the cash flow is falling, it makes it like not so cool for us. Because one important thing in an LBO is that you want to pay back your debt. If the cash flow is falling, automatically it means that your debt will be in trouble. You can't pay down the debt, and essentially you can default, and that can cause problem. So that's why the cash flows that this one has, even though it is cheap, makes it like the worst candidate. So yeah. Any questions before we go to the next thing? I hope it's clear. All right, good. So we'll go to the next point, which is like we have paper LBO. So now this is like the calculation part, and I want us to, like, you know, have our eyes and ears open. I want to teach you something called the rule of 72 and the rule of 114. So what the rule of 72 essentially is, okay, let me start from the returns metrics in an LBO. The most important return metrics in an LBO is what we call IRR, internal rate of return, and money on money multiple. Those are like the two most important way you analyze the success or failure of an LBO. Remember, I told you that when you are modeling an LBO, you model it over a short period of time, maybe 5 years. And then within that 5-year period, you want to have an exit so that you get your money back. In analyzing like what your return looks like, you use two metrics: IRR, internal rate of return, and money on money multiple. Those are like the two important things that you use. And because of that, there are some kind of calculations you can easily do, which is called paper LBO. I'm not going to do the full LBO, just like paper LBO, so that you can be able to like solve things and very, very quickly. So now the rule of 72. So when a company doubles over a period of time, you use the rule of 72 to calculate what the internal rate of return looks like. So let's use a simple example. Let's say let's use a very simple example. Rule of 72. So this is a mathematical concept anyway that we now adopted in finance. So company doubles in 2 years. You want to get the IRR. So what you just do is just divide 70, just say 72 divided by the number of years 2. So this is going to give you what the, why is this 72 divided by 2? What's happening to my numbers here? 72 divided by 2, 36%. I don't know what is happening. So this is supposed to be 36%. I don't know why my numbers are like getting very, very bad. It's supposed to be 32%. It's supposed to be 30, let me just leave the percentage. This is essentially 36%. So what this essentially tells you is that if you double your investment in a 2-year period, your IRR is 36%. Now, let's do for 3 years. 72 divided by 3, 24%. It reduces. Let's say you double it in 4 years. 72 divided by 4, 18%. 5 years, 72 divided by 5, 14.4%, which is essentially, we just use like approximately 15%. The reason why I'm telling you these things is that this one is for 2 years, this is for 3 years, this is for 4 years, this is for 5 years. This is when you double, this is essentially where you double your equity. If you double your equity, remember what I said, you double your equity. Sorry. Equity doubles in 2 years. Your internal rate of return is now 36, 24, 18, 15, 14.4%. These numbers are numbers you should know. You should just necessarily be especially for the 5th year. But there's a concept I want to bring out. The earlier you exit an investment, the higher your IRR tend to be. So if you exit your investment in year 1, automatically it means that your IRR is 100%. The reason why we are using the rule of 72 and not like 100% is because of the compounding nature of IRR. So IRR compounds like a compounding metric. So even though you make 100, you like double your money in 2 years, it should have been, IRR should have been 50-50. But it's less because of the compounding effect of IRR. As a mathematical concept, I don't want to go into that. But we use the rule of 72 in finance usually when we say our investment doubled over a period of time for you to get your IRR. So your investment doubled over 5 years, you'll say 72 divided by 5 to get what it is, usually 15. Then if your investment triples, you use the rule of 114. So in the same vein, we do the same thing here. If we want to get our IRR, your equity tripled over a 2-year period. So 114 divided by 2, 57%. Equity tripled over a period of 3 years, 38%. Equity tripled over a period of 4 years, 28.5%. Equity tripled over a period of 5 years, 22.8%. Usually, these numbers are not accurate to the T, but they just give you a sense when you are like in an interview. They just tell you, ask you a question, you just use these particular formulas to get an answer very quickly. That's typically the kind of question they will ask you like in an interview, around paper LBOs. So now, given this particular principle, though for 5, because 5 is a very popular one, we know what it is to the T. So this 22.8% is really not, it is like around 25%. That's what this 5 years is. This one is around 25%. Why when it doubles is 15%? You should know these two. These two are something you should know. You should know it. The IRR, you should know it for 5 years exit and then 2 years. And but when equity doubles in 5 years and then when equity triples in 5 years, you should know these things. These are like things that you should know coming to memory. So on that particular basis, I want to ask you a question. Let's solve these things. Good. Yeah. So who can tell me what this one is? Question 1. What's the answer? IRR. What is the IRR? Quickly. So what?
15%.
15%. Good. Number 2.
%.
Excellent. Number 3. I think these are very simple questions, so we should be 25%. Good.
33%.
So,
oh, 25%. This is okay.
Yeah, tripled.
Yeah, 35%.
Okay, good, excellent. Yeah, so now let's go to the other parts of paper LBO, which is like, the other parts. let's try to solve this question. So as I said, there are important things you should know. As I said, the exit multiples in an LBO is usually like, you know, money on money and IRR. So we want to display those things today, right now, for the next 5 to 10 minutes, and then we'll ask questions and call it a day. So let's answer this question. It says that what? Let me just copy this so that it's easy for us to solve it in on Excel. I just like us solving questions on Excel. It's way easier to solve. All right, let's go. So, oh my God. Oh my God.
I just changed it. Okay.
Okay, good. So let me see if I can bold in it. Good. So now we have 9x EV EBITDA, 5 years, same multiple. So what we're saying here is our entry multiple. Whenever you are solving an LBO question, there are things you want to know. You want to know what the entry price is. You want to know what the exit price is. You want to know what the IRR is. You want to know what the debt and equity ratio is. You want to know what the EBITDA is. You want to know what the money on money is. What happens in this case is that they might give you some of these things and ask you to calculate one. So that's what you want to know. Now, right now, let's calculate this very quickly. They said our 9x EV EBITDA. So our entry price, usually our entry multiple and our exit multiple is the same. Well, that's what we used to assume. Remember, I told you that there are 3 ways you create value. Number 1, I said EBITDA growth. Number 2, I said debt pay down. Number 3 is multiple expansion. So multiple expansion, as I said, is that you buy something at 9x, you're selling it at 10x. But for the case of an LBO modeling, we don't typically assume that the multiple expanded. We are very conservative. So we say the multiple you bought is the same multiple you sell. So that leaves 2 levers for growth for you. One is EBITDA growth. You have to improve the company so that you can be able to get more money. Because if you buy the company and the EBITDA is 100 and you are able to improve the EBITDA to like maybe 150 or 200, even though you are selling it for 5x. In the beginning, you bought it 5x EBITDA is 100, 500. But even in the end, if you're still selling it for 5x, because of the EBITDA improved from 100 to 200, 5 times 200 is now what? 1,000. So you're not selling it higher, even though you are selling at the same multiple. So we assume the same entry multiple and the same exit multiple, usually in an LBO analysis for conservative purposes. Good. And that's why you see PE companies tend to, like, what they do is they do some financial engineering. They fire people. They tell you that they want to optimize operations. They fire people. They close a lot of things just because they want to optimize the cost. The implication of that it flows into the EBITDA or profit in this case, and the company becomes more profitable because those are the levers they can pull. Good. So the enterprise is what? 9x EV EBITDA. Then, so because of that, this is EV EBITDA. EBITDA. So what's our EBITDA? Our EBITDA is what? We say here is 100, right? So what does our enterprise value? What's our enterprise value in this case? Who can tell me what the enterprise value is? Please, you can say it out because I am not seeing the screen. 900. Good. 9 times 100. So that means like the enterprise value, the value of the company in this case is 9 times the EBITDA it is generating. That's what the market's placed on it, 900. Good. So exits, we assume the same thing. Exit is going to be 9 times 2. But now, what is our exit EBITDA? We don't know. We don't know what our exit EBITDA is. We don't know. So we don't know what our exit value is. Our exit value, we don't know. We don't know. Good. So the next thing again we have is that we have our IRR is what? Our IRR is 25%. I shouldn't have even put this thing here. I didn't have put something here, 25%. So remember, they said that this investment is for 5 years. When you hear that the investment is for 5 years and then the IRR is 25%, What does that tell you about the money on money? It means that the money on money did what?
Tripled.
It tripled. Good. You just know that the money on money tripled. So what is money on money calculation? Money on money calculation is given as exit equity over entry equity. That's essentially what money on money is. So we'll get there shortly. The next thing they told you is that your debt is 4x. That's essentially what it is. When you hear this thing, 4x is usually, it's just the same thing with like EV EBITDA, same thing as debt. Debt is also done debt to EBITDA, except they say otherwise. So it means that your debt is what? Your debt is 4 times what? 4 times of the EBITDA, entry EBITDA, because it is when it is in the beginning that you are buying the company. So it is 400. So what does that leave your equity as? Remember, I told you that it's only equity and debt that are the instruments in an LBO. So if debt is 400 and you bought the company for 900, essentially your equity is going to be what? The value divided by minus 500. Good, excellent. Then remember, the question is asking us how much is our EBITDA growth. That's essentially what it's telling us. That's what we are trying to calculate. For EBITDA growth, we have our entry EBITDA. We want to get our exit EBITDA to be able to get our EBITDA growth over the period. So in this case, for us to be able to get our exit EBITDA, we already know that our equity is 500. This is our entry equity. We want to know what our exit equity is. We already know that money on money is what? Money on money is 3x. It tripled. We know that for sure. And our exit equity divided by our entry equity. Our entry equity is 500. So as I said here, we know that our money on money is 3x. Our exit equity over our entry equity is equal to 3. So essentially what it means, our exit equity is going to be what? 500 times 3, which is 1,500. That's what our exit equity is. Now we know that our exit equity is 500. We know that our exit equity is 1,500. Exit equity is equal to 1,500. But we want to get what is our exit value. What was our entire exit value? That's what we want to get. And we know that from the question, it told us that half of our debt was paid down as at year 5. Remember, our debt was 400. If they are saying 5, they're saying half of it has been paid. Upon exit, debt upon exit is going to be what? 400 divided by 2, which is going to be what? 200. So this is the only debt that is left upon exit that we have not paid. And that is also part of the exit value. Remember, enterprise value is the formula for enterprise value at a simple level is equity value plus net debt. Because enterprise value, which is the value of a company, is usually the portion that is attributable to equity holders and the portion attributable to debt holders. That's usually what the value of a company is when you hear the word enterprise value. So in this particular case, we already know the value that's attributable to the equity holders is 1,500. The ones attributable to debt holders is what? 200, the one that's not been paid. So the total exit value is equal to
1,700.
Plus 200, which is what? 1,700. That's it. Now, remember that they said our exit multiple is 9x. 9x of the EBITDA. We know that we already know what our exit value is. Oh, sorry, I can't do that. 1700. Sorry, 1700. We already know that. So our exit EBITDA is going to be what? The exit value divided by what? By the exit multiple 9. This is what our exit EBITDA now is. The question told us how much is EBITDA growth. So EBITDA growth is pretty straightforward now. We can be able to get the EBITDA growth. Our EBITDA growth is what? This over this minus 1. So 89%. That is what the full EBITDA growth for the period. Usually they might go further and tell you what was the EBITDA growth for each year. For us to be able to calculate this, we have to do the KGAR formula. I don't want to do the KGAR formula, but you can. One of the things you can do is you can just do something that is a rough estimation. For a rough estimation, since you know that this particular company grew for like 5 years, you can just say this divided by 5 to get a rough estimation. This is not the correct thing anyway, but to give you something close, it should be lower than this, but we'll give you something close. You just get an idea. Okay, this company was growing its EBITDA every single year for something lower than 17% every year for it to get to 89%. So the key driver for this particular LBO is what? EBITDA growth. For it to be able to triple its value in 3 years, in 5 years, the key driver was what? EBITDA growth. EBITDA grew by 89% within the period. I think the other one is debt pay down. Any questions here? Good. I will have one last question that I wanted to solve, but I don't think we will be able to have the time to solve it. So I'll give you as an assignment. So now, you can solve this one. I wanted to solve this one too, but maybe the next time we meet, we can talk about this. So guys, the last thing I want to say in this particular class is that, first off, thank you very much for being available. I really appreciate the commitment. I know it is not easy to sacrifice your time to come and learn. But one of the encouragements I want to give you is that whatever dreams you have or whatever passions you have, especially when it comes to finance, the best way to be able to learn finance is by practicing. So you will hear a lot of people say a lot of things, but the easiest and the best way you can learn is to practice. I don't expect that everything I said here is something that you already have internalized 100%, but one of the simplest and easiest way for you to go is to keep practicing, pushing, and then you get better at it. The second thing I want to say is that one of the easiest way to learn finance is by reading financial statements, especially from the SEC. Nigerian financial statements, yes, but also you want to read statements from other countries. Focus on some of the business, the management analysis of their business. Read those things. You might not just read the numbers, just read those things. Then you can start, but you can also understand the fundamentals. By fundamentals, I mean understanding ratios, something like debt equity ratio, something like earnings per share. Those kind of simple calculations, it will help you understand how companies differ from other companies. You can do a balance sheet sizing, which is the percentage of elements over total assets within a balance sheet. You can also do margin analysis, which is percentage of different elements in the income statement divided by revenue. Just do simple analysis and compare different companies. That's the way you get better, and then you now understand, okay, this company, this is what their ratios look like versus this other one. Start at that basic level. You now start asking questions. Then another thing again that differentiates people is curiosity. And one of the ways you can douse your curiosity is by listening to podcasts, especially finance podcasts where they talk about finance things that are related to finance. That way you get better at understanding and analyzing issues, and you are able to understand things from a very granular level. Then my emails, DMs are always open if you have questions. Maybe you are trying to move to the next level in your career, or you're trying to understand certain things, or you just want to hear from me advice. You can always reach out. If I'm not available, I'll book a call and then we'll be able to talk it through. on that particular note, it was really nice spending these 3 days with you guys. I've learned a lot from you guys, and I hope that you also have learned 1 or 2 things from me. Until next time, I don't know, does anyone have any question for the last time so we can address it?
So, sir, I wanted to ask, so if one is an industry, you're working in an industry that doesn't allow you to learn the core finance thing you want to learn, so what do you do? Because I understand the best way to have a mastery of some of these things is actually doing it. Working on the spreadsheet over time gives you that mastery. But if you're not disposed to have this hands-on experience, so what do you do? Do you continue reading up theories and continue learning, reading up articles and I mean, watching YouTube videos without actually having the experience, hands-on experience? I believe that would help. So what do you advise?
I'm going to give you, again, at this particular, I think you have to stop recording me now, please. Can you stop recording? So that I can be very sincere. Thank you. So I'll give you.
I was also streaming, so I have to stop streaming.
Okay. At this point, if you want to leave, you can leave. I think we are done with the training now. Right now,